Shri Gurubhyo Namaha children. Welcome to our online class, Ekalavya. Standard 12, Subject Economics, Lesson 5, Monetary Economics. This is the concept map. So far we have completed Monetary Economics Introduction, Meaning, Definitions, Evolution and Functions of Money, Supply of Money. Also we have completed Quantity Theories of Money. In that we have completed Irving Fisher's, Alfred Marsh's cash balance theory and Keynes' quantity theory of money. We have completed. Then, what is inflation? The meaning of inflation and the types of inflation on the basis of speed we have completed. Today, we are going to learn about types of inflation on the basis of inducement. Then, causes of inflation, effects of inflation, and what are the measures to control over the inflation. Okay? Thank you, children. Let us start from the beginning. The types of inflation. According to the inducement. Types of inflation on the basis of inducement are: number 1, currency inflation. Number 2, credit inflation. Number 3, deficit induced inflation. Number 4, profit induced inflation. Number 5, scarcity induced inflation. Number 6, tax induced inflation. What do you mean by induce? Inducement or induced, whatever it may be. It is nothing but influence. Okay? Influence is nothing but inducement. Currency infused inflation. That means the excess supply of money in circulation causes a rise in price level. Number 2, credit inflation. When the banks are liberal in lending credit, the money supply increases and thereby raising prices. So the inflation rises. Deficit influenced inflation. The deficit budget is generally financed through printing of currency by the central bank. As a result, the prices rise. Number 4, profit influenced induced inflation. When the firms aim at higher point, they fix the price with a higher margin. So the prices will go up. Then inflation. Scarcity induced inflation. Scarcity of goods happens either due to fall in production or due to hoarding and black marketing. This also pushes up the price. So it is called as scarcity induced inflation. Tax induced inflation. Increase in indirect taxes like excise duty, custom duty, and sales tax may lead to rise in the price. For example, petrol, diesel. This is called tax inflation. Now, let us see what are the causes of inflation. They are nine in number. Number one, increase in money supply. Number two, increase in disposable income. Number three, increase in public expenditure. Number four, increase in consumer spending. Number five, cheap money policy. Number six, deficit financing. Number seven, black assets, activities, and money. Number eight, repayment of public debt. Number nine, increase in exports. All these related to the sixth lesson, banking. So we will go in detail about it, but a little about each and every heading will go through now. Increase in money supply. Inflation is caused by an increase in supply of money which leads to increase in aggregate demand. The higher the growth rate of the nominal money supply, the higher is the rate of inflation. How much the higher the growth rate of nominal money supply is going on increasing. That means if the growth of nominal money supply is increasing, the higher rate of inflation also it will be higher, it will be increasing. Increase in disposable income. When the disposable income of the people increases, it raises their demand for goods and services. Disposable income may increase with the raise in national income or reduction in taxes or reduction in the savings of the people. Disposable income is nothing but the income which they are receiving after the deduction of the tax. Increase in public expenditure. Government activities have been expanding due to the developmental activities and social welfare programs. This also causes a price level. So, increases in public expenditure. Increase in consumer spending. The demand for goods and services increases when they are given credit to buy the goods on hire purchase and installment basis. Cheap money policy. Cheap money policy or the policy of credit expansion also leads to increase in money supply which raises the demand for goods and services in the economy. Deficit financing. In order to meet the mounting expenses, the government resorts to deficit financing by borrowing from the public and even by printing more notes. This raises aggregate demand in relation to aggregate supply, thereby leading to inflationary rise in prices. Black assets, activities, and money. The existence of black money and black assets due to corruption, the tax evasion, etc., increase the aggregate demand. People spend such money lavishly. Black marketing and hoarding reduces the supply of goods. These trends tend to raise the price level further. Repayment of public debt. Whenever the government repays its past internal debt to the public, it leads to the increase in money supply with the public. This tends to the rise the aggregate demand for goods and services. Increase in exports. When exports are increased, domestic supply of goods decline. So the prices will rise. So far we have seen what are the causes of inflation. Now let us see what are the effects of inflation. The effects of inflation can be classified into two. Number one, effects on production. Number two, effects on distribution. Let us see first one, effects on production. When inflation is very moderate, it acts as an incentive to traders and the producers. Traders are nothing but business people. Producers are nothing but manufacturers. This particularly prior to the full employment when resources are not fully utilized. The profit due to rising prices encourages the induces business class to increase their investments in production, leading to the generation of employment and income. Effects in production. Let us go in detail. However, hyperinflation reflects in a serious depreciation of the value of money and it discourages a saving on the part of the public. When the value of money undergoes considerable depreciation, this may even drain out the foreign capital already invested in the country. Third one, with reduced capital of accumulation, the investment will suffer a serious set of back, which may have a adverse effect, unfavorable effect on the value of production in the country. This may discourage entrepreneurs and the businessmen from taking business risk. Fourth one, inflation also lead to the hoarding of essential goods both by the traders as well as the consumers and thus leading to still higher inflation rate. Number 5, inflation encourages investment in speculative activities rather than productive purposes. Effects on distribution. Effects on distribution is under four headings. Number one, debtors and creditors. During inflation, debtors are the gainers while the creditors are losers. The reason is that the debtors had borrowed when the purchasing power of the money was high and now repay the loans when the purchasing power of money is low due to the rising prices. Fixed income groups, second point. The fixed income groups are the worst hit during inflation because their incomes being fixed do not bear any relationship with the rising cost of living. Examples are wage, salary, pension, interest, rent, etc. Third point, entrepreneurs. Inflation is a boon to the entrepreneurs whether they are manufacturers, traders, merchants, businessmen, because it serves as a tonic for business enterprise. They experience windfall gains. Windfall gains is nothing but unexpected gains as the prices of their inventories or the stocks suddenly is going up. Fourth point, investors. The investors who generally invest the fixed interest yielding bonds and securities have much to lose during inflation. On the contrary, those who invest in shares stand to, to gain by rich dividends and appreciation in value of shares. Okay, so far we have seen the causes and the effects of inflation in production and distribution. Now, how to control over this inflation? What are the measures have been found out? By whom? Now we are going to see. Keynes and Milton Friedman together suggested three measures to prevent and control of inflation. They are number one, monetary measures, number two, physical measures, number three, other measures. Let us go in detail one by one. Monetary measures. These measures are adopted by the central bank of the country. They are increase in bank rate, sale of government securities in the open market, higher cash reserve ratio and statutory liquid ratio, CRR and SLR. 4. Consumer credit control. 5. Higher margin requirements. 6. Higher repo rate and reverse repo rate, RR and triple R, RRR. All these points will be going in deep in the sixth lesson, banking lesson. Okay, I'll teach you what are all the monetary measures we are going to learn in sixth lesson. Physical measures. Fiscal policy is now recognized as an important instrument to tackle an inflationary situation. The major anti-inflationary fiscal measures are as follows. Number one, reduction of government expenditure. Number two, public borrowing. And number three, exchanging taxation. Now, let us see the other measures. Other measures have been divided into short term and long term measures. Short term measures. Short term measures can be in regard to the public distribution of scarce essential commodities through fair price shops, that is, ration shops. Okay, through rationing. In India, whenever the shortage of basic goods has been felt, the government has resorted to import so that inflation may not get triggered. Number two, long term measures. Long term measures will require accelerating economic growth, especially of the wage goods, which have a direct bearing on the general price and the cost of living. Some restrictions on the present consumption may help in improving saving and investment, which may be necessary for accelerating the rate of growth of economy in the long run. So far we have completed the measures to control over the inflation. Now let us see the meaning for deflation, disinflation and stagflation. The essential feature of deflation is falling prices, reduced money supply and unemployment. What is inflation? Raising price level. What is deflation? Reducing price level, falling price level, and reduced in the money supply also and unemployment. So you should know the meaning for inflation, deflation, disinflation, stagflation, and reflation. Okay, which I am going to give you now. Though falling prices are desirable at the time of inflation, such a fall will not lead to the fall in the level of production and employment. But if the prices fall from the level of full employment, both income and employment will be adversely affected. Disinflation. Disinflation is the slowing down the rate of inflation by controlling the amount of credit. Example, bank loan, hire purchase available to the consumers without causing more unemployment. Inflation is raising price level. Deflation is reducing price level, reducing money supply, reducing unemployment. Disinflation is without causing more unemployment. Controlling the inflation is called disinflation. Now let us see the stagflation. Stagflation is a combination of stagnant economic growth, high employment, and a high inflation. Okay, reflation. Reflation is a process of bringing an economy out of recession by increasing the amount of money in the circulation within it. Are you able to understand all the meanings for deflation, inflation, disinflation, stagflation, reflation, children? I'll give you once again the meaning for these, and then let us continue the next class. Thank you, children. Have a nice day.